For this video, we have selected 3 top stocks for you that could potentially achieve super high returns, at least higher than the S&P 500. And the definition of top stocks is statistical, given the higher chance of success versus the overall markets in the sector they are in. So it's a relative valuation based on statistical models, and from our experience, it works, but you don't have to take my word for it. The facts speak for themselves. For example, the first stock that I will show you has already achieved a 60% return in just 1 month. We mentioned that stock in our analysis about the 7 best small cap stocks for 2025. Of course, if you mention 7, surely there will be at least one that performs phenomenally. But in any case, we have already made it happen within a month. And also other stocks from that selection of small cap stocks, some of them have even achieved returns of up to 40%. And so also one already 60% in just 1 month. That's obviously extremely high. Are we assuming that everything we do is gold? Definitely not. There's also a bit of luck involved. Only one thing is true. We select our top stocks using a fixed methodology from statistical data tools and data sources where we pay more than 7,000 euros per year. And what do we do ourselves? And in particular, I am that as an investment analyst at Happy Investors. It's a lot of going through, looking at which companies still have potential, just scalable with a strong earning model, and preferably with good management, and can still grow in the long term. Because if you have the combination of short-term and long-term quality, yes, that's where you find the big winners. You just need patience for the last part. A lot of people don't have the patience. So it may be that the short term is often better or worse than the long term. And for that, these top stocks, so remember well, these are stocks mentioned in statistics that could possibly outperform. But of the 2 out of 3, I do have a good feeling about it. The first one, however, where it has already achieved a 60% return, and now we're going to take a look, it's a bit more risky than most people would want to. I think so. Finally, just very briefly, do you find our videos valuable? Has it helped you with financial freedom or investing? Or is it going, are you helping, of course? I would really appreciate it. If you could take a moment to like the video and to subscribe, that helps our channel grow. If our channel grows, then it has more money available, then we can invest more in better quality videos that help you achieve financial freedom. Thank you for that. And now let's take a look at the top 3 stocks for February 2025, which hopefully will benefit us all. 3 weeks ago on the exact date, in January 2025, we shared an analysis of the 7 best small cap stocks for 2025. And one of those is the high risk stock, Opve. And that still remains a top stock even for February. We mentioned Opve back then at a price of 8.6. That price has increased by about 60% return in less than a month. So everyone who has benefited from Opve, I'm really curious. Just let me know in the comments. Of course, I think it's really great that you've achieved a 60% return. But for me, Opve was a bit too risky to invest in myself. But you can see that the methodologies we apply and have been using for years on our channel, Happy Investors, where you also get monthly access to a selective stock that we believe can outperform, that just works in a demonstrable way. For 3 years now, we have been achieving higher than average driving figures return, and we do that thanks to various tools, including the factor analysis. And a lot is just think differently than the market, but also just based on facts, statistics, and not too much. Sometimes think for yourself because you see a lot of risks. The best way to invest then is actually with small percentages. I'm not saying this is the best way to invest. Definitely not. There are many ways. But if the market wants to beat and outperform and achieve high returns, on average, then you have to do something different. And one of the ways is, for example, investing in risky stocks like Opvi. Well, I would invest a very small percentage here if I were you, but that's entirely up to you. So be careful with the downside. Risk. Why is this stock performing? Well, is that good? Well, it's just growing very quickly and unexpectedly fast too. So the current valuation is around 15 for next year, and that's still relatively cheap, even when we look at the price to sales. So it looks like there will be huge revenue growth next year as well. Price to cash is very cheap. The market value is just 1 billion, a little more than 1 billion. Well, they do have quite a bit of debt. But Opfi is, of course, a solutions platform with loans, with money. So that's why they obviously need financing. That growth is exorbitant. The e-payment growth for next year is still expected to be around 46%. And the EPS growth can be enormous, it can be enormous because they are moving from a loss-making position to a profitable position. So then you suddenly have rapid profit growth. That's why these numbers look so extremely high. Well, the profitability is still very low, only 2.8%. But here lies the opportunity for Opve Om. More profits are expected to be made in a relatively short time, and New England equity is surprisingly high, especially for this small cap company. So very interesting. And Zexrank also thinks that it's a strong buy, so they give it a factor of 1. Strong buy. Their target price is $16. I'm not saying that OPFI is the best company to invest in, but you achieve high returns by simply performing differently or doing things differently than the market. It can also backfire, of course, so be careful with what you do. If we look at a bit of historical valuation, it still seems to be trading around its intrinsic value. Yes, that's only based on earnings per share estimates for the next 2 years. What's more important here is to do thorough research from how much profit could this company make, and will they achieve more profit growth in the long term? That is really the crucial question. Definitely also to reduce risks here and avoid potential losses. But OPFI remains a top stock, and that's what this video is about. This video is about top stocks that could statistically outperform. Well, the factor analysis is a 4.99. It doesn't go higher than 5. So statistically speaking, this stock definitely has the chance to continue outperforming versus, for example, the S&P 500, all in comparison to, but at very high risk, for sure. And yes, I'm not surprised that there's also a short-term. A correction may come, however, it seems that it just keeps rising. And potential return is very difficult to determine for this super stock, but the EPS estimates are from only a handful of analysts, so that could be very wrong. Is indeed relatively high, but you can see that the algorithm here, on one hand, 2%, and then in 2026, 30%, is that a really big difference? So it still sticks to a price to earnings ratio of 16.8. Let's really assume that this is true. That means an average profit growth of about 15% for the next 2 years. Sounds realistic given the platform, but it could also just as easily disappoint or be much more. Let's assume a price to earnings ratio of 15, then the average return would still be about 13.7% over the next 2 years. But this is definitely not going to follow a perfect linear line. And the opposite is also true. For example, take a look at the IPO or SPAC, whatever it was. After that, it dropped by 80%. So how can this happen? That a company first drops by minus 80% and then grows exponentially with a return of around 550%. It's always just really bizarre how the market can work. However, remember, in the long run, the market is a weighing machine and only the best companies will succeed in the long run. Outperform. And Opve is definitely not one of the best companies I would invest in. But we see the risk-return profile. It would be a small percentage allocation, so for example 1%, it could surprisingly turn out to be quite a lot. Simply by letting such a small risky stock grow, if it is nothing at all, so it blows up, it goes back to minus 80%, for example. So you would lose 80% on your 1% invested money, which is relatively very little. So you invest relatively small amounts in very risky investments, and if it doesn't work out, then you won't lose much money. If it does work out, then it will be worth a lot of money in the long run. It's a bit like investing in crypto, also very speculative. And the advantage of Opve is that you can at least dive deep into the numbers. So research, for example, the balance sheet, look at the income statement. What's going on here? Are they going to make more profit and revenue? And also take a look at the cash flow statement. All things you need to research yourself, of course. And we only present ideas that could possibly make this a top stock based on factor analysis. But it's up to you to do further research and avoid risks. It sounds like the same selection of the 7 best small cap stocks. We also mentioned Argan, and we don't just show the winners. Argan has actually performed worse over the past month, and this seems to be an interesting entry point because Argan still scores high on the factor analysis and thus meets the definition of top stocks. And moreover, this company might perform significantly better than expected. And why is it worth repeating? Because the price has dropped a lot. So we also mentioned Argan at a price level of around, January 7th? So that's about here. And since then, it has actually dropped by about 12%. So that's a poor performance in a month's time, of course. while it initially started to rise quite strongly. Well, why could this still be an interesting second step within? This is a moment to step in. Excuse me. That's because based on technical analysis, we suddenly see a resistance, a support level emerging. So what we see on a daily level is that we've adjusted the time frame from a month to a week. We see here that a support level has been found at the price level of 133, and that is after a significant drop of about 27, 28%. And that drop was caused by news from China regarding DeepSeek. That artificial intelligence from China could be very cheap. And Argon is a company that is positioned for artificial intelligence because this company is a portfolio holding that creates energy, creates for databases. So that's why the news from Mint has led to a price drop of 18%, while the facts and statistics actually indicate that there is still a strong buy. So this could very well be a super instant moment for this stock for the coming year. And that's why we mention it once again, because we've actually mentioned it before on January 8th. Well, that was actually at a slightly higher price level. And from January 8th, it had first risen by 19% in 3 weeks. So actually, we could have named Argon as a winner already a month later, but unfortunately the news was against it, and down 0.5%. So a significant drop in the long term could actually mean an interesting entry point. It's not without risk, of course, because the price doesn't just drop by 30% based on a little news article. Well, on one hand, the valuation of Argon is already a bit high. That's a risk. I mentioned that in the other analysis as well. The price to earnings for next year is estimated at 27, and that's really on the higher side, even for this type of company. So why would you still want to invest? Because of the potential growth. The growth is estimated for next year, 25%. But more importantly, the EBITDA growth is also estimated at 26% growth, and the EBITDA growth is even at 30%. So those are very important figures. But I think Argon is more of a long-term play. So for the next 6 to 12 months, and for the long term, I'm not so sure. It depends on how they continue to perform in terms of profit growth in the long term. And we also see that, for example, the return on equity is currently doing opposite. Well, that's significantly higher than the 5-year average. And also, the profit margin of 8% is significantly higher than the 5-year average. So it has created a momentum here for faster profits. Could this be the last? What would that growth curve mean? I'm not really sure about that. That's the tricky part about Argon. So here, should you still do your own research and hope? Of course, based on research, we expect that the profits will continue to grow. The profits are growing. It's all about profit growth. You should be able to determine that because on a historical scale, Argon seems overvalued. However, if we look at, for example, 7 years, then we see the price earnings of 27. That has already dropped significantly from 35 to 27. It's still always on the high side, but the good prospects seem to be okay in themselves. And what could that mean? Well, if Argon maintains a price to earnings ratio that is adjusted for growth, then it would actually come out to 22. Then you can achieve a potential return of 12%. I really think that based on 10 years of investing experience, also with these algorithms and databases, and certainly that the price drop of at least 30% was based on news, because I would just wait for the quarterly report. But Argon has a very good chance, at least before 2025, to perform better than the S&P 500 based on growth. Also, take a look at the third quarter results and what the CEO definitely comments on. And one of the important things is, for example, the backlog, but also that they are very convinced of planned energy facilities. And of course, for the very strong growth in response to the demand for energy. And Argon is GEPRO. I position myself, of course, as one of the companies to provide energy for example, databases. So why is it very interesting to study Argon closely? It could very well outperform, and this temporary dip of 30%, which is a lot, of course, in a short time of 1 or 2 days, it could lead to a nice entry point, specifically for this year. For the very long term, I don't know that, but it has opportunities to outperform in the short term. Balance it. The stock for this month as an update is Powell Industry, and I have taken a position myself. The company with the ticker Powell, a small position of just €2,000. That is converted for me 1%. of this portfolio that we see. So a 1% position in a high risk stock is obviously not a lot in terms of allocation. And I think Powell Industry is super interesting. Now, who thinks that stocks aren't interesting? And crypto is everything. Then you don't know much about stocks because pay attention. Stocks might actually be much more interesting than crypto. I bought Powell Industry on January 17th, and actually within 2 days, it was already at a 20% return. But unfortunately, then the news from DeepSeek also came out, AI rightly so, and then the drop was about 28%. So anyway, now after the recovery, it's about minus 24% based on news from China, because Powell Industry is also a stock, a company with a relatively small market value of about 3 billion, positioning for data centers and electrical solutions. So everything that has to do with the growth of artificial intelligence, it had dropped a lot, and Powell Industry is an example of that. So I have a small position myself, as you can see, from around $2,000. That's 1%. It's now at minus 7% after this abrupt drop, while initially it was a great entry point. But unfortunately, the drop actually presents a buying opportunity. I'm not buying in myself yet. Maybe it will drop a bit more to a lower level. Who can say? And should I maybe buy an extra percent for Powell Industry? I've also shared a closer analysis, a deep dive into this company within our community. But here's a quick scan. First of all, the valuation of Powell Industry after this significant decline of about 25% has become interesting. Again, the price to earnings ratio for next year is estimated to be around 17.6. More importantly, the price to earnings ratio is still relatively healthy compared to the sector median. I would prefer to have it below 1, but some companies seem to be a bit more expensive from time to time. You don't always have a price to earnings ratio under 1. It does have some downsides, I must say. Sometimes it's better to invest in stocks with very strong momentum, and Paul is an example of that. The price to cash flow is a bit on the high side. The market value is now about 3 billion. They have no debt, so that's very important. Almost no debt. They do have a healthy cash position. The management is very experienced, can I assure you, long-term already in service of the company, and they have a very interesting backlog of upcoming projects. We don't want to guarantee success, but Paul and Industry has a lot of cards in hand to become successful, not just this year, but also for the long term. The revenue growth is quite impressive and a bit higher than, for example, the 5-year average. So there is really strong momentum going. Here again, the theme is artificial intelligence. And even if things don't go well with data centers and whatever else, you still need a business like Paul and Industry. Of course, they have electrical solutions, and electricity is needed for a lot of things. So relevant for the future. I'm estimating the growth for next year at no less than 48. EPS growth of no less than 46%. So extremely good statistics. And the current profit margin has also become impressive, at least more impressive, 15%. And that is, to be honest, compared to the sector median, the return on equity is currently very high. The return on total capital is also very high. So there is a lot. It's all going in the right direction for this company with the wind at their back. So that's very positive. The recent price increase is obviously huge, and it seems that the stock might be overvalued, but that's not the case. Are we looking at a scale of 7 years, for example? And in relation to future profit growth, it could be that the stock is even slightly undervalued. It all depends on which price to earnings ratio you use, because the small selection of a handful of analysts, 3 and 2, which isn't a lot, expects an EPS growth of 10%. Even for around a 10% growth in EPS isn't super high. And if you then use a price to earnings ratio of 15, while the current price to earnings in this model is 8.9, then you have minus 3% achieved return. So the price to earnings ratio definitely needs to be higher in the long run. Or should the growth be higher? And I expect that it will be I expect that the growth will be higher, that EPS growth, the 10% that's included in this model. So I can't provide an illustration of what that means here in this model, but I have my own Excel sheet for intrinsic value calculation based on discounted cash flow. Of course, the classic way to break down intrinsic value, and I've included other scenario analyses in there, which I think Paul and the industry can definitely achieve a positive return from. Zech Schrenk thinks it's a hold at the moment. just to talk about the hour, to see that their price target for the next 6 to 12 months is $255 dollars. So we're actually expecting a higher price by 2026. And if we look at the EPS development, then we see that the stock price is actually hovering around that EPS development. So that would mean a fair value, just because the whole industry has dropped so much in the short term. And we see here what they call at a technical level, a kind of support line has formed. Could this be an interesting entry point? And we enjoy the factor analysis is very positive. I have a positive experience with it myself. And it's also aimed at the long term with management. So I think Powell Industries could surprise us. I'm not saying this is the absolute best stock out there. Then I would have invested more money in it. It's also risky. So I've only taken a small position of 1%. Remember, 1% isn't much. That's 100% money that you can invest. I did that for a reason. Why? Small company, 3 billion market value. If it goes from 10 to 30 billion, well, that's great. So that 1% is not 10% in relative terms, but it's still a lot more. And if it doesn't work out, then you've only lost 1% of your money. So always in relation to risk and return. Keep that in mind. By the way, every month I give an update on the recent transactions I make within my portfolio. So definitely follow us, happy investors, subscribe and like the video. And then you won't miss any updates about our new sales in stocks and ETFs. That was it about Pole Industry and the other two top stocks in FAI and Argon. I'm curious to know what you think. Pay close attention. These are high-risk stocks. Take good care of your money and only invest what you understand. Of course, everything is for inspiration and not investment advice. You know how it goes. Thank you for watching. I hope you enjoyed it. And I also hope that all three of these stocks perform well. But yeah, we don't have everything in our hands, so time will tell.